Federal Reserve Chair Jerome Powell says a strong majority of Fed policymakers expect 2 or more interest rate hikes before the year is over. He made those comments this morning at a conference in Madrid. Joining us now to talk about the market impact of the Fed's actions, Meera Pandit, the global market strategist at JPMorgan Asset Management. Good morning, Meera. Great to have you here.
Thank you for having me.
So you say the markets are in between. So is that sweet spot or purgatory?
It feels a little bit like purgatory right now for investors because we are after the inflation spikes and the majority of the Fed hikes, but we are probably before a more pronounced economic slowdown and a more pronounced profits slowdown. So it leaves investors in a little bit of no man's land. Should I stay or should I go? And I think the reality is if we look at the majority of the market, it's relatively stable outside of course, the surging 7 stocks. And I think that is a good thing because it means valuations are near their long-term averages. So we're not seeing too much, overpricing in that segment of the market, which is the majority of the market. I'd also say, look, investors should be a little bit primed for a pullback in the second half of the year and expect some volatility. But I don't think we're going to need to retest those October lows from last year. And when we think about the next catalyst going forward, it's really going to be earnings. We've been talking all about the Fed and the July rate hike, but I think the earnings season is going to give us some tangible outlook on what the consumer is going to do and which companies can do well.
If we do have a pullback because there's more recession fears or recession glimmers start to appear, is the market stronger because most of the gains are focused in 7 stocks, or is the market more vulnerable?
I think the market's stronger because, again, the rest of the S&P 500 outside of these small number of stocks are reasonably valued and have been pretty resilient overall to the repricing within the Fed and what the Fed's expectations are over the years. So I think this could be somewhat of a durable market when we think about the rest of the players. Maybe they experience, again, a bit of whiplash from some of the gyrations in the economy and profits. But overall, I think that this is a good thing for the markets that we haven't seen everything run really far.
Do we need to see the markets continue? We've been seeing glimmers of broadening out in terms of the sectors that are participating in this market run. Do we need to see that continue for the markets to maintain these levels?
I'm not sure that we need to. And I mean, you see a little bit of a rotation, but you continue to see that it's really tech that's dominating the headlines. What I would encourage investors to think about is where can we access some of these AI themes outside of just that small number of stocks? Because we can't price the entire AI revolution into a very small number of names. So let's think abroad, internationally. There's a lot of tech players over in Asia, so we're finding some attractive valuations and other opportunities there. And in the private markets as well, because, again, we have a lot of concentration within the public markets. And if we think about areas like private equity and where that can be a big player in AI going forward, we see fewer and fewer companies over time going public. So companies stay private for longer. They get more mature in the private markets. And if we think about the Russell 2000 as somewhat of a proxy for some of the exposures within private equity, what we actually see underneath the surface is you see almost triple the amount of exposure to tech and private equity versus in the public small cap index. So I think a lot of the next generation, the next round of really successful AI players are going to come within those private markets, which is why we're thinking more about how we can gear our investors towards those segments of untapped opportunity.
That seems like a tacit acknowledgement, or maybe an overt one, that there is too much froth maybe in some of the AI plays that we're seeing here run.
Absolutely. If we think about the index overall of the S&P 500, what you're seeing is that those top 10 stocks overall make up almost 30% of the index. And back during 2020 and 2021, when tech profits were so strong, they basically made out a commensurate area of profitability within the index. But now those top 10 stocks make up about 18 or 19% of the overall profitability of the index. So as an investor, we want that to be somewhat commensurate. We want to be mindful of some of these higher valuations. We want to be mindful of some of these concentration risks. We'll be closely watching profits within the tech sector to see how they continue to evolve. But the reality is so many of the gains in AI are impossible to model at this point. And we've priced in so much that may not actually be rooted in what eventually plays out.
What kind of feedback do you get from the analysts who cover NVIDIA and the companies that have to, they are modeling this in because that's what the companies are doing. The companies are saying these are in our forecast. NVIDIA's $11 billion revenue forecast for the year. That's in the forecast.
I think even the typical analyst would acknowledge that it's hard to see the entire runway of this AI story play out. And it's also hard to assume what sort of beneficiaries will come about in applications we haven't even invented yet. So I think that we want to be just a little bit cautious. I mean, maybe we're in a bit of uncharted territory because some of these very profitable, stable companies with a number of different business segments that have been pretty durable over time are being the net gainers at this point. But again, as investors, we want to think about that holistic portfolio. Right. Are we getting things at a reasonable price? Are we eliminating any vulnerabilities to a pullback? Because often the areas with the highest valuations are the most vulnerable. So we really want to seek some balance in this environment. You know, a lot of people have this recency bias about how strong some of these things have done year to date. But let's not forget 2022 when we saw a massive pullback in a lot of these areas. So we have to be a little bit more balanced and neutral as investors, as hard as that might be.